Are we live?
I think so.
Okay. I want to make sure that is the channels added correctly. I think we're live, but okay. Yep. Okay. I think we're live. All right. Sorry, everybody. This was a little technical, not a glitch, but just checking, make sure everything's running okay. Welcome to the VIT podcast. This is our third stream, and you guys know my name is Becca and Hari.
Howdy.
We are recording this on August 4th, 2020. Right now, where I sit, it is 7 a.m. So the market has not opened. Welcome, everybody. So we're going to talk about a few things today that's on the news. Uber finally makes profit. We covered Uber in previous episodes. It's an interesting company. We'll talk about that. Pelosi visit to Taiwan. This is the banger right here. I mean, to me, it just came out of nowhere, and I was following this pretty closely. Really interesting, kind of dangerous too subject we'll talk about. And then Walmart layoff. I mean, Walmart is just one of the examples of companies that have laid off a whole bunch of people, and so we'll talk about what that means. All right. Anything else to add, Hari, before we start?
Well, yeah, just we've like Becco said, this is our third podcast back, and we're trying to grow the podcast again. So we'd appreciate it if you can like the videos, comment on them, and subscribe if you haven't already. That would really help us out. We'll have some more interesting stuff coming up here in the next few weeks, announcements wise. But if you haven't joined our Slack channel, or you have questions, you can email us at info@valueinvestor.org. We'd be happy to answer them. Or if you have any topics you'd like us to cover in the next streams, just let us know.
Okay, great. Let's get started. Uber finally makes a profit. Talk us through that, Hari.
So, we've kind of we had a good podcast, early on talking about Lyft and its business model. Uber has a very similar kind of model in terms of how they sell things. Lyft, however, is focused solely on rides, whereas Uber is doing more like food delivery and other things. So interestingly, as the pandemic kind of let up, people started using Uber again, and they've actually had drivers flock to it. So this last quarter, they actually saw their revenue almost double, or actually more than double, which is to $8 billion, which is is impressive, and with gross bookings of almost $30 billion. But what's kind of interesting about this is that they actually posted a GAAP loss for the quarter. And that is largely due to the accounting rules around owning lots of other marketable securities. But they actually turned in a free cash flow profit of $380 million. Now, mind you, how much money has been poured into this business over the last 10 years to get them to the point where they actually turn in a free cash flow profit? They've invested, 30 something billion dollars to get to this point. But so a free cash flow profit of $380 million is not it's not a lot. And they still, so this isn't, we talked about this there's an accounting profit, which they have a negative accounting profit, and an economic profit, which is their cash flow side. But there's two things that I think that are interesting from this that, as an investor, you should kind of pay attention to, because I don't think this is still a business that you would want to invest in, is that they consider their business asset light, and that's what their CEO announced during the quarter. Um, and the irony of that is that yes, it is an asset light business because your drivers, are driving their own cars, and you're basically just connecting them with riders. Um, but the thing is that the reason they don't make any money is that they have a huge liability associated with insuring each one of these ad hoc rides. And so they have to set aside a huge amount of their profit to protect against insurance liabilities, which may happen a year, 2 years, 3 years down the line.
Just hold there for a second. This is one thing that we talked about during the Lyft episode. And by the way, I want to correct myself. The episode that I talked about earlier, we didn't cover Uber. We covered Lyft. Thanks for correcting me on that, Hari. So
Yeah.
this is where it gets interesting. When we took a look at this, and to be honest, I haven't looked at Lyft or Uber in a while. But when we first took a look at this, one of the things that really stood out was the insurance side of the business, how the liability associated with this is pretty enormous. So what you were saying, Hari, is Uber's balance sheet is no different than Lyft's, and it sounds like the insurance side of the things is really kind of a big monster that they have to carry. Is that right?
And yeah, they've always had an insurance. Insurance has been a huge part of it, and they've actually self-insured. They're not sending third parties, so they essentially just set aside money for payouts related to these. And so, like a $10 Uber ride, the vast majority of the time there's no problem with it. But then the driver gets into an accident, right? The other party can sue the driver, but they actually sue Uber because they're driving under the Uber umbrella. And so, but what to me was actually very interesting about this is their 6 month, the Q2 ending 2022, they actually post an $8 billion net income loss. And then when you actually look at all of the cash flow adjustments that they make, they have almost $830 million in stock-based compensation, which I agree is not a cash, thing. But it's $830 million of essentially dilution that you as an investor are going to face, right? And so it's a big deal. And then they had an unrealized loss on debt and equity securities net of $7.2 billion.
Wow.
So this is how you go from, you're essentially just sloshing around a bunch of cash.
Can you talk about that last bit there, 7 point something billion?
Yeah, they're essentially just adjusting for their stock portfolio changing right during the quarter. And so when you look at the net income of negative $8.5 billion, and then you say, well, we didn't actually lose that money. What ended up happening was our portfolio of stocks were readjusted.
Their treasury management, basically.
Yeah, those were adjusted, and so in the old GAAP accounting system, that wasn't accounted for. So your net income was actually a lot more reflective of your cash flow, because you're essentially trying to adjust for what's on your balance sheet went down. So you adjust it against your earnings, and then now they have to adjust it against cash flow also. So when you really boil all of this down, right, my takeaways from this is Uber is not going to be consistently free cash flow positive, I think, for a long time, if ever, because they can make adjustments here and there to kind of make things look positive. The stock got a big bump, but the fundamental problem here, as we've always talked about, is what is their actual moat here, and can they actually charge enough money to make an economic profit? And what they've done is they've cut a bunch of their incentives, their driver incentives and other things to make this profit happen. But what'll end up happening is they're not going to get enough drivers in the next 6 months or 12 months if the price is too low, right? And people aren't going to come to drive for them. Most drivers are only there for a couple of months and then they go find a job or something else because it's not worth it, for them to do that for long term. And so that was the same thing we talked about with Lyft, right? Is that they're either going to lower the price of the rides or pay the drivers money to get them to come work for them, or both. And if they pull too hard on one of those levers, eventually, the riders don't show up or the drivers don't show up. So last week we talked about Facebook and network effects, right? They've tried to build up the network, but they have to keep pouring money into maintaining the network. And I think the end result of that network effect is going to be it's not really a moat that they're creating, right? They have a size that allows them to do these kind of things, but long term, I don't think this is going to be they may squeak out a profit here and there, but it's not going to be a very profitable business.
I wonder, just a couple of things come to my mind. I wonder why they chose to self-insure. I mean, I can guess, but I would love to kind of dig into that. And then the second thing that makes me, at least in the short term, positive or bullish on Uber and all these different companies is that maybe this is sort of tying to the third bullet point, which is the layoffs. Usually, right, when you like, for example, in Houston, when the oil price dips below $50 or something like that, there's massive layoff in the oil and gas industry because it's not profitable. So what do people do? They go work at restaurants or they do some temp job just to get them by until the oil price gets back up, and then the industry can absorb these people again. Perhaps this is pure speculation. When the market does turn with unemployment number, maybe it'll be a boon for them because drivers will sign up and maybe that'll help. But in the short term, that's I want to highlight that this is the short term kind of thing. Still, the fundamental business model seems a little bit loose. Yeah, I agree with all your points.
Yeah, and I think you made several good things. Said several good things there because they're cyclical in nature, related to the overall economy. Maybe they can slash driver incentives now, but as the economy comes back and picks up again, right? I think they'd have to reintroduce those things, and so to get drivers into the door. So I think it's always going to be this kind of cycle, right? Where you're going to struggle to get drivers, you're going to struggle to get riders. And right now, maybe drivers are easier than getting riders,
Yeah. Just one more point before we move on to the next topic. Do you know the revenue mix from the actual rides versus Uber Eats? Because I remember when pandemic hit, Uber Eats was outpacing the actual ride business, and that was kind of a cash cow. What do you know?
So I actually didn't look into the split, but I do know that the majority of the growth here came from people taking the rides, and that because it had compared to last year was such a low amount. So I don't expect that they're going to continue to see that kind of growth.
Yeah.
Going forward, and I think we're actually at a point where Uber doesn't have a lot of room to grow, right? In terms of
the size.
Yeah. Look, the whole original business model of like nobody's going to own a car, they're just going to take Uber everywhere. That's never going to happen, right? It's just not profitable to take, spend $20, if you live in a city of Houston just to go to work, right? Maybe once in a while, but it's mostly like we're going out to party or whatever, and you don't want to have a car with you. So
let's move on to the next topic. Pelosi visit Taiwan. Man, this was kind of, it was it was like I don't know. To me, it felt like a movie. Uh, I mean, it has. What do you have any thoughts on this?
Well, I think the interesting thing to me that I think was like it kind of just came out of nowhere, right? That she's visiting Taiwan. There was a lot of like speculation that it was just going to be an Asia visit, and then Taiwan was included, and then it was not, and then I think like there were like hundreds of thousands of people watching the plane, like on like the flight trackers,
Yeah,
just to see if she's actually going there, right?
yeah,
Um, but it's, I mean, the obviously the visit itself to Taiwan is not what's the story, but the fact that China's response to it, which has been, they've done military exercises. I think last night, um, Houston time, last night they shot missiles over. Uh, they didn't hit Taiwan, but they went over Taiwan airspace and landed. So they are threatening, military action here, all because we are trying to recognize Taiwan as a separate entity from China.
hmm yeah. To me, I mean, if you look at the map of the exercise, it's basically like I don't know. It looks like it's they're preparing for invasion. It's like if you look at the map of Taiwan and the area that Chinese Chinese Navy and the military is planning on the exercise, it's basically encircling the entire island. And that's
Yeah.
what they would do if they actually went to war. That's what they would do, right? It's to cut off all supplies coming into the country by complete encapsulating them. Um, I guess I don't know what's the takeaway or what's the I guess is it just is it just like from where we stand it's like this it's an important geopolitical thing. What is the I don't know what should we be looking out for? I feel like this is you
So
know
I think for us as investors, I think the first thing to look at is Taiwan is an enormous supplier of chips and semiconductors and things like that we are using for everything, right? So if you remember at the beginning of the pandemic when we couldn't get, chips, and I think it lasted almost 2 years into the pandemic, there were cars that were sitting idle after had being manufactured that they were waiting on processors. There were, GPUs for like your computers. Everything was being affected by that. I would say that if you look at it that way and then scale this up to by like a factor of 100, if Taiwan is invaded or anything of that sort happens, because for one thing, we're not going to be able to ship. Like there is no reserve capacity for us to make a lot of these things elsewhere. So companies like AMD, who rely heavily on Taiwan, are going to be significantly impacted. Um, the company TSMC is the one that actually makes all of this stuff, um, and we are trying to make these fabs, which are these multi-billion-dollar plants that make chips, trying to make them in the United States, and it's not going to happen for like the next 4 or 5 years uh, to any like reasonable capacity. Um, so I mean the seriousness of this is pretty significant. On the flip side, our reliance on China also means that China has a huge economic. It's not in China's economic interest to uh, go to war with anyone, because that means that they're not going to be able to ship their goods to those countries, right? I imagine you'd have some blockade or tariffs or something like that on items from China. Um, so really, I mean, this is U.S. China tensions as much as it is like could have a huge impact on the entire economy, since we rely so heavily on China for almost everything.
Yeah, I want to zoom in on the semiconductor side of the business here. It is so incredible that, I mean, this is something that we talked about when we talk about like AMD or Nvidia in the previous episodes. They don't manufacture stuff domestically. What happens is, they have this. I mean, one of the most interesting podcasts that I've ever done with you, Hari, is Nvidia, and that
Yep.
is because the complicated nature of these supply chains are absolutely incredible. I mean, you
Yep.
get like parts from this and that, and then you assemble it here, and then you ship it over to Japan, and then Japan goes to. It's just an insane level of webbing is threading all these different countries. If one breaks, the whole thing collapses. There isn't a lot of resistance, or not resistance, resilience baked into the system. And big part of that is Taiwan. Taiwan is sort of, it's like this linchpin of all the semiconductor supply chain. If that screw gets loosened up a little, like it's just going to cause massive ripple effect across the entire economy. That's where I'm focused on, and I think that's why the West and everybody else is so interested in protecting this economic interest. And
Right.
there's like this, and I believe it when people say like veneer. Maybe veneer is kind of wrong term, but it's they're in support for democracy. That's all like very true. But I think there's more than that. It's the economic. What's at stake is quite high when it comes to Taiwan. Um, it's
Right.
beyond democracy. It's much more. It gets down to can we like survive as global economy. So I think that's really interesting to watch.
Well, I think there's two things too that, you know, like the impact, to almost everything, your smartphone, your high end servers, all of those things will be hit by this kind of impact. Apple makes all of their devices on TMC fabs, right? So and they actually pre-buy time on those fabs to make, so that they have enough supply for their supply of phones and tablets and all of that stuff, right? Which and these are the kind of things that would have an impact on us, is that there is a known amount of like degradation and decay of our devices. We replenish them. Like if you go to a war, a war with someone like China may last years, and that means you're going to have to build up your own supply of a lot of these things, right? So it's not a, this is like a World War II kind of level uh, thing, right? In terms of it would disrupt the entire economy of the world and so forth. So um, yeah, I think what I would mostly say to anybody here, to think about this is, as Americans, as under the Trump administration, there was a lot of kind of posturing with China. They were actually imposed tariffs on China because of, and we actually saw supply chains kind of move to other countries, right, to Vietnam and other places. Um, to be honest with you, if we are thinking that China is going to make a move for Taiwan, we should have started that process of shifting supply chains significantly away from China. And I think the same is true for Taiwan. Actually, we should be building up all of the capacity here in the U.S. Um, and forgetting whatever reliance that we have on other places.
Yeah, I mean this. You're basically fighting. I mean, I think that in principle is sound. The problem with that is you're fighting like you're trying to swim upstream when it comes to like all these labor costs. In the last
Yep.
30 years, that's exactly what happened, right? I mean, this is kind of the playbook of developed nation, is that you outsource these like actual manufacturing to other countries where labor is cheap, and then you keep services components in house. And then a little, something that requires a little bit more kind of white collar kind of work.
Yeah.
going the other direction is just, it's going to take a lot of momentum and a lot of push, and something like this could do it. And this sort of ties into the other topic that we talked about in the previous episode of the bill that's passed or that's about to pass,
Yeah.
the semiconductor.
So yeah, I was actually mistaken. Thanks for bringing that up. It has not passed, but the and neither has the Inflation Reduction Act. They are
Yeah,
still kicking around right now,
yeah,
but they're both expected to pass at this point.
yeah. So just going back, just trying to, yeah, just to finish my point, it is, it is incredibly difficult to swim upstream. And I think this is basically what we are called to do if something like this does happen. And as we've seen with the supply chain fragility, we need to build in more resilience.
Yep.
And it's a very difficult thing to do because that's not been the playbook for the last 30, 40 years. So I mean, maybe forever, really. Um, anyway, definitely something that we have to keep an eye on here. Let's move on to the next topic. Walmart layoff. So layoffs are happening.
Yeah, and I think we had talked about this in the when we said, at the beginning of a recession, you don't necessarily see uh, job reductions, and we've had a very tight labor market for at 3.6% post pandemic, and now I think we're starting to see the beginnings of some layoffs. So you want to talk about the where Walmart is doing this?
Yeah, let's see. So, yeah, unemployment rate sitting below 4%. When COVID hit, just to give you some context, when COVID hit, it peaked. The unemployment rate peaked above 14%. So we're quite low, compared to the economic zeitgeist and the situation that we're in right now. But we're starting to see some cracks now. And I think most people that are watching this have probably seen headlines of companies announcing these big layoffs. Walmart is just the latest to do this. So I'm just going to list out some companies that already announced layoffs. So Walmart laying off 200 corporate employees. Oracle, Robinhood, Shopify, um, and some startup companies like Olive that raised a ton of money. Healthcare companies, healthcare systems are laying off people. Rivian, the famous electric car maker. OpenSea, I mean, crypto is being decimated. Not just the coins themselves, but companies that operate in them.
Yeah,
So the list goes
Coinbase.
on and on, right? Twitter is laying off people. And then in addition to the layoffs, people are announcing, obviously, freeze in hiring. So this is coming, right? This is coming. So when people lose their job, this is when people really start to tighten their belt and austerity comes in. And once that kicks in, you're going to see the effects of, self-imposed austerity reflected in the economic market, in the broader market, right? People are not going to be shopping more, things like that. So as we talked about in the earlier podcast, the demand destruction, I think we're going to see it more in the coming months.
Yeah, and I think it's a good point to start looking at. A lot of these companies are profitable. They have a they're very profitable, like Walmart and Google, and some that are not so much. But like the Robin Hoods and these that were never really generating a huge amount of money, uh, were laying off like 10-20% of their workforce. And so I think what you're going to start seeing is that this is going to start accelerating in the next quarter, and that list is going to grow to hundreds of businesses. Um, and the CEO of Google was actually saying that they had more employees than they actually had work at Google, And I don't know if that's going to end up being a you know, leading directly to layoffs, but they haven't announced anything. But this is in the last couple of days that they've kind of hinted at that stuff. So I think what we're going to start seeing is that this tight labor market will start easing a little bit. People will start pulling back on spending because they suspect their job is going to go away. And then what we're going to see is that the easing of inflation starts to happen there. But I also thought it was really interesting that Walmart and Target both have a huge rise in inventories. They've both announced during their quarterly reports, and they were essentially saying that we bought a lot of stuff that people were buying during the pandemic, and we have a bunch of overstock of that stuff, and can't get rid of it. And so they have a lot of like discounting that's going on right now as a result of that. So I think it's going to be really interesting for the next 2 to 3 months. You're going to start seeing a huge shift in the labor force away from like we're not going to be in hiring at all cost mode anymore, which I think is actually unfortunately necessary at this point. As much pain as that's going to cause, because it's going to lead to a lot slower growth in the money, in spending, which I think is necessary at this point.
Yeah, which makes it, my mind jumps to, okay, everybody is talking about Federal Reserve pivot. Everybody has turned into a speculator, right?
Yep.
And macroeconomist. I mean, but it's sort of unfortunate reality, but that's the world we live in right now. So much of it is tied to this economic situation, macro situation. So it's important to kind of pay attention to it. Does this mean that inflation is going to come down, and because we're in a recession, the pivot is going to happen like at the end of this year, early next year? It sounds like the market is kind of pricing that in. If you look at kind of the bond market and other areas, do you have a take on that, Hari?
My fear right now is that the inflationary cycle that we're seeing right now is being driven by, I think, a couple of things. One is oil prices have gone up significantly, and that's like the input for almost everything that we use. And then the second one is that government spending has been insane, right? Like we are spending trillions of dollars that was not part of the economy. And this past week, we talked about the CHIPS Act, which I'm fine with. The actual part that goes to the chips, but then there was research and development that was like $200 billion, and then there was this act that was actually enacted here in the last week or so about giving healthcare for veterans around burn pits, which sounds great. I don't think anybody really opposed it, except they added an extra $250 billion of discretionary spending, which means basically they can use it for whatever they want over time. And so what ended up happening is that you now have a bunch of money that's being required to be spent, right? I'm sorry, it's non-discretionary spending. So this is money that is part of this bill that has to be spent somewhere. And so, you keep doing this over and over again, and suddenly everybody's looking at it like we have so much extra cash, and then it goes to fueling jobs that don't, matter, right? Or it's being spent on, the bridges to nowhere and things like that. And that's how you create more inflation, right? Not to mention, deficit, right, in your budget. So these are the kind of things that we have to get under control. And I know we're not a political podcast, but right, there is a we're not a political podcast, but these are the impacts that have consequences on our portfolios, right? Is inflation is being like we're pouring gas into this onto this fire. So
yeah, I mean, the government spending is a problem, and I think I think something that whenever something like this comes up, becomes kind of contentious because it obviously has a political tinge to it. I would just want to say that when we talk about political, this government spending, I think it's important to acknowledge the good intentions that people have. Some of these things are very well intentioned, like
Yeah.
helping out veterans, providing subsidies for onshoring semiconductor industries. All these are like really good things. It does have these downstream second order, third order effects that can be kind of detrimental to the economy. The
Yeah.
wealth, the health of the economy, the well functioning health of the economy. It almost feels like caffeine, and it's like caffeine, right? It's
Yep.
once you have one cup of coffee, you need two, you need three, et cetera, et cetera. So um, yeah, I just want to mention that because I think it's very easy to paint the picture of these guys are like just trying to out there to destroy the economy or whatever, right? Whatever people can say about the other party or whatever. It's not. I think it's important to recognize the good intentions. Yeah.
All right.
Anything else on this?
I just want to. There was a comment on the stream from Jim Varney. Haha. I would like to see Central America be included in some of the supply chain restructuring, which is a good point, right? We would want that supply chain to kind of move towards, if you're in the United States, to move towards more domestically closer partners, and we already have things like NAFTA and to protect some of that stuff. So I think that's actually a good comment that relying on China is kind of a problem, but it doesn't have to necessarily be all domestic, right? We could actually move that stuff into places closer to home that we have more closer ties with.
Yeah, it's a good point. We haven't really touched on Central America or South America. Um, Jim, would love to see you guys do another show on discounted cash flow. Yeah, that could be a topic.
Yeah, we'll definitely bring that up. So
Yeah, yeah, yeah. The question of Central America onshoring and then putting it in more of a Central America. I wonder if you could leave a comment on what kind of industries would make sense to bring it to Central America, given it sounds like a thing or two about that. Maybe there's some, I don't know, like a kind of burning, like a budding industry there that could be interesting to look at.
yep.
Leave a comment if you can, Jim. All right, that's it for me. Ari?
All right. Well, we're gonna be doing live streams every Thursday morning at 6 a.m. Central, 7 Eastern, going forward. So if you're, we'd love to have you all come in if you're listening to this after the stream's ended. But if you are watching it afterwards, please comment also on any thoughts that you had related to to the supply chain stuff we talked about, or any other topics. Discounted cash flow is a great topic to always revisit. We'll be happy to talk about that on the next episode.
Yeah. I'll just add to one more thing. Just add to that. If you guys have companies, I know a lot of people watch our podcast to get the analysis of companies. If you guys have companies that you want us to analyze, leave that in the comments. We'll take a look and do our best to cover them.
Yeah, and I'll plug one more thing for us. We have a blog where we talk about various topics. Also, the blog.valueinvestor.org. If you can take a look at it, and we'll be publishing an article a couple of times a week. Last time I talked about Carvana, which is a car rental or car dealer without any people involved, and how even a disruptive business like it has actually not shown an economic profit, which is a theme that we've seen with companies like Uber and stuff like that. So would love for you guys to check it out and interact with us here on the stream or on YouTube, or send us an email at info@valueinvestor.org.
All right. Thanks so much, guys. I'll see you guys next week.
All right. Thanks.